YouTube, how are we doing? In this video, I'm going to talk about some of the things that have made one of the biggest differences to my own performance. I already share this with the premium members, and I'm also going to share it to you right now. No matter what strategy you are using to trade, smart money concept, supply and demand, EAs, Fibonacci's, no matter what strategy you are using to trade, if you apply the concepts that I'm going to share to you right now, you're going to definitely boost your strike rate, because if you are mapping your kind of market structure in the right way and consistently, you're gonna find yourself on the right side of the market most times. You are gonna skyrocket your average low to risk ratio because you're gonna know where to target. Secondly, you're gonna hold trades more confidently to your targets as well. I kindly wanted to do this video as a 10-minute video or 15-minute video, but if you can't concentrate in a sort of 30 to 40 minutes, probably you're not gonna make it, bro, as the crypto fanboys love to say. I'm gonna open the charts and we get a bit more practical. Yeah, the PDF that I'm using right now, you can download it on free in the description below. Yeah, it is there. So we are going to look into this book, and it's called Market Structure. If you need it, the link is down the description. Yeah. Expansion and retracement. Expansion occurs when there is an impulse movement towards a direction. Then retracement is a correction movement after an impulse movement. I'm going to explain this. Yeah. This is an uptrend and this is a downtrend. Two examples at the same time. Expansion is represented by E, retracement is represented by R. E, expansion, retracement. Expansion, retracement. Remember, they have told us when the expansion occurs when there is an impulse movement towards a direction, or the retracement is the correction movement after an impulse move. It means after an impulse move, we always expect a retracement to occur, then we wait another expansion movement or impulse movement, then a retracement again, an impulse movement, retracement, impulse. Then in a downtrend, expansion is always going down, retracement moving up a little bit, then expansion again, retracement, expansion. Yeah. Let's see on the chart. This is the chart. We have expansion, retracement, expansion, retracement, expansion, retracement. I'm going to go deep into this. Keep watching. Expansion, retracement, then market changes character, then it has a break of structure here. I'm going to explain that also. Then let's go skip this. I already explained this Fibonacci in the recent video, so if you need to know more about the Fibonacci, go into my videos, check it out, very helpful. So let's go to this BMS, or break in market structure. The BMS occurs when the price closes above or below a swing high or swing low. Generally, every trader should trade in the direction of a higher time frame, or the BMS. Yeah. Go deep. After the BMS, always wait for retracement. As I said, expansion, retracement, expansion. So here we have expansion. This is what the retracement. When the market was making another expansion, it broke the structure down here. This is what they call the BMS. When the market breaks the structure, breaks the recent low that it made, or the recent low, or the range low. The market makes another expansion, retracement, breaks structure here by breaking this range low or recent low. Yeah, the market makes a retracement, expansion, retracement, expansion, breaking the structure. Then the market breaks the structure at the top again, which makes it a BMS at the top, because the market has moved and then it broke the structure, reached the recent high or the range high. Yeah, let me go deep into this. Range high and range low. Let me explain this also. After the BMS, there will always be a formation of a new consolidation that is called range high and range low. When the market is moving down or up, it will be making range highs and range lows and range highs. Okay, trade in the direction of the BMS. After the BMS, wait for the retracement to 50% or OTE of the Fibonacci levels. I told you the Fibonacci, I taught it in the recent videos, check them out. Yeah, everything is there. Let's see here, we have the bullish and the bearish. This is the BMS because this was a retracement, then the expansion blocked the structure here. That's what is called the BMS. Then this is the range low because the market stopped here before making another expansion at the top, making it a range low. This is a range high because the market stopped here while making a retracement to this level, then buying again. Yeah, the same thing to bearish. Expansion, retracement, the market stopped here, then changed direction, then moved down, breaking this structure down, then making the higher range high here, range low here because the market stopped here, then make the retracement before making an expansion again. I hope I'm explaining the best way so you can understand the best way. You can comment down below if you have any question in this video, and I can DM you right away. Okay, yeah, subscribe if you're new to the channel. If you're a subscriber, thanks for watching again. We have expansion, retracement, expansion, retracement, expansion, range low, BMS because the market broke the structure, range high because the market stopped here before moving down again, range low as I told you, OTE, range low. OTE means the market moved from low to these levels of the Fibonacci. As I said before, OTE, it is the Fibonacci levels where the market is. Okay, the Fibonacci has levels. There's 50%, 60%, 70%, and 88%, which we consider most. So this market retraced to the 70% of the Fibonacci levels, which are called OTE. As you see, this OTE represents Fibonacci levels. Okay, OTE, market retraced in the OTE levels of the Fibonacci, then sold again, making a range low and a break of structure down here. Yeah, hope I'm explaining the best way. You have a failure swing or the SMS. Let's see this also. When there is an uptrend market and the price fails to break this last top or swing high and breaks the previous bottom, swing low, an SMS is considered to have occurred. Vice versa for the bearish. Let me see this. Let us see this also. Failure swing. This is a bullish market. So when the market is making expansion movements, retracement movements, breaking structure here at the top, the market while making this second expansion, it broke the structure which is represented by BMS, then it made another range high here down, then it retraced to make a range low, then it moved another expansion to break the structure here, making another range high at the top here, retracing to make a range low down here, also range low here down. So when the market was moving to break the structure again, for this to become a break of structure, the market failed to break the structure at the top, which means the market made an SMS, which is called failure to break the market structure. The market failed to break the market structure, so it failed, then it broke the market structure down, making this a BMS down, because if it fails at the top, in most cases it breaks at the bottom, and then it makes it becomes a downtrend by breaking structure, continuing breaking structure down. Okay, let me explain this further on the right chart. Expansion, BMS, because the market has broke the structure at the top here, then it made a range high, a range low again while retracing. When it retraced, it failed to break the structure at the top, which means it made an SMS. While it has made an SMS, when the market fails to break the structure at the top, that indicates that the market is likely to change direction into a downtrend. As you can see here, the market failed to break the structure up, making an SMS, then it started breaking structure down, as you see, then this became a BMS. Okay, the market retraced to the Fibonacci OTE levels, then again break the structure down, making this a BMS. Market retraced, then made another break of structure down below. Okay, let me continue to this. We have another chapter, which is the market structure. Market structure, the price can simply be found in one of the three phases below: in a consolidation, in an uptrend, in a downtrend. Okay, I'm going to explain this as well one by one. Market structure in bullish conditions, vice versa for the bearish conditions. The bullish market is characterized by making higher highs and higher lows, but this characterization is not enough. It is necessary to say that bullish markets are always breaking swing highs and respecting swing lows. Hope you are understanding what I'm saying right now. Okay, the fact that the price broken a swing high indicates that the higher prices should be expected. So let me first explain this. The fact that the price has broken a swing high indicates that the higher prices should be expected. If the market is in an uptrend and then it breaks the structure at the top, that will indicate that the market, that particular currency, is likely to increase to increase in price or to continue buying because it is breaking structures at the top. But when the market makes an SMS, that indicates that the market is likely going to change into a bearish trend. Okay, yeah. Market structure in bullish conditions, vice versa for the bearish conditions. Market expansion, as I said, retracement, expansion, break of structure, range high, OTE levels of Fibonacci, as I said, expansion, break of structure at the top here, range high, retracement to OTE levels of Fibonacci, range low, as you can see, LR, then expansion again, market breaks the structure in between here. Yeah, so notice the price is breaking the higher highs, so the highs only. After the BMS, the price retraces to 50% OTE levels of the Fibonacci, then LRB, low risk buy. Okay, yeah, so they are trying to explain that when the market is making expansion and retracements, the market will always retrace to 50% of OTE levels of the Fibonacci, which means when this is our low and our high according to the Fibonacci, the market will retrace 50% of this expansion movement that was made at first. When the market retraces 50% of the expansion movement that was made at first, it will buy again to break the structure at the top again. So LRB, low risk buy, means when the market retraces 50% of the Fibonacci levels or in between the expansion, you can buy because we will have a low risk buy. The market is already continuing in an uptrend by confirming that by making BMSs at the top. BMS, yeah. So when the market continues breaking structure here at the top, you can wait for it to retrace 50% of the OTE levels of the Fibonacci, then you enter another buy at the top so the market can make another movement at the top while you are in profit. Okay, so this is another chart representing the same thing: market structure in bullish conditions, vice versa for the bearish conditions. BMS down, this market is making a consolidation, then it broke the structure here. As you can see, break of structure when the market hits the range highs, it has broken the structure. The range low or low risk buy according to the Fibonacci levels, you can buy here because you'll be in the 70% of the Fibonacci levels. The market breaks the structure again, then you wait for the market to retrace 50% of the expansion that was made at first. This is the expansion movement from here to here. When the market retraces 50% of the expansion movement, you buy it again, so you can take all these profits until the market breaks another break of structure at the top. You wait for it 50% of the expansion movement that was made at first, then you buy again to go in profits until the market breaks the structure at the top again. I hope I'm explaining this in the best way. Okay, market structure again. All in all, they are explaining all in all. A BMS, retracement, BMS, retracement, OTE levels of the Fibonacci. Market makes an expansion, range high, range low, OTE levels of Fibonacci. Market breaks the structure when it is moving in this third expansion movement. Market makes a range high here, max makes a range low, stops here because this is the 50% of the Fibonacci levels, or the 50% of the expansion movement that was made at first. Then the market makes another break of structure at the top. While the market makes another break of structure at the top, also makes another range high at the top. Then the market makes another retracement, which this retracement that it made at this time, it broke the structure at the bottom, which means the market is likely to change direction into a downtrend because it has broke structure at the down. Remember, they told us when the market breaks structure, we should follow the break of structure. Where the market breaks the structure, that's where we should trade following. So when the market breaks structure at the top, we continue buying this market. When the market breaks structure at the bottom, so we consider starting to sell this market. So when the market broke this structure down here, I started considering selling it when it reaches 50% of this expansion that is made while breaking the structure down. So it retraced into 60%, so 60% of retracement levels of Fibonacci, then started selling off again. Okay, hope I'm explaining this in the best way. Yeah, that's it for today. This is the next topic: liquidity in supply and demand. This book is very long, as you can see. You have 153 pages on this book, so if you need to know more about this book, you can check it out in the link down in the description, or DM me on Instagram. I'll inbox you right away. Thank you for watching. See you next time.